Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, our fund analysts share their foreign stock favorites to increase your international equity exposure. Christine Benz discusses her model retirement saver and bucket portfolios. Director of Passive Strategies, Alex Bryan, on which parts of the market are more ideal for an active approach. Equity analyst Dan Romanoff highlights why wide-moat Aspen is well positioned for an oil and gas rebound. And analyst Emory Zink recommends how to pick a short-term bond fund. Let's get started. First, our fund analysts share their foreign stock favorites to increase your international equity exposure.
Hi, I'm Susan Jabinski from Morningstar. As a group, international stocks rebounded in 2019, yet U.S. stocks did even better. And as a result, investors may find that their portfolios are more exposed to U.S. stocks than they might think. Here are three of our favorite foreign stock funds for bringing balance to your portfolio in 2020.
Oakmark International Small Cap is an excellent option for rebalancing because it uses a proven approach to invest in international small cap stocks. It has a very experienced manager, David Harrow, who runs gold-rated Oakmark International, and he's ably assisted by Justin Hance and Mike Minnelli, two veteran Harris Associates analysts who are also on Harris Associates stock selection team. They use the same approach as they use at Oakmark International. They look for stocks that are trading at discounts to their estimates of their intrinsic value, and they hold on for a long period of time. They like to buy when things are under a cloud or facing some sort of company-specific controversy, and they like to hold until their theses play out. The result is you have a portfolio that doesn't look like the index or its peers. It has a very lumpy risk-return profile. For example, in 2018, it lost about 24%, but then it bounced back in 2019 with a 32% return. So you have to be prepared to ride out some rough periods in this portfolio, in this stock fund.
Vanguard FTSE All-World ex-US Index Fund is a great long-term index fund. This is one of the most diversified portfolios in Morningstar's foreign large blend category. It captures stocks from more than 40 developed and emerging markets listed outside of the U.S. The emerging markets section of this portfolio only compromises 20% of the fund's assets, so its inherently risky nature isn't likely to affect the fund's performance over the long term. This is also one of the most diversified portfolios you can get, so the stock-specific risk also isn't likely to affect the fund's performance. The other thing we really like about the fund is its market cap-weighted approach. This sort of approach emphasizes larger, more stable companies while de-emphasizing companies that are smaller and more volatile. It also helps reduce turnover, which can contribute to lower trading costs at the end of the day. Finally, we also like the fund's ultra-low fee. It's one of the cheapest in Morningstar's foreign large blend category, which should help it perform or outperform a lot of its peers over the long run.
If you're looking for an international stock fund to help rebalance your portfolio after U.S. stock funds have outperformed so much in the past few years, one good choice would be American Fund's International Growth and Income. What sets this fund apart is its income mandate. Almost all the stocks it owns are dividend payers, and that helps assure that they're not troubled companies. They have the wherewithal to pay out some dividends consistently. But they're not the highest dividends, which is good. You wouldn't want troubled companies that can't afford to keep paying those dividends. But I wouldn't call it a defensive fund, though, because it has a substantial emerging market stake. So in downturns, it doesn't necessarily provide a cushion. It also has a growth tilt. But overall, it has a very good record over time. And the flip side is that it can outperform in rallies, as it did in 2019. It also has very low cost, like most American funds. So all in all, American Fund's International Growth and Income would be a good choice if you're looking for an international stock fund at this time.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa.
Now, Christine Benz's model retirement saver and bucket portfolios.
Hi, I'm Susan Jabinski from Morningstar. Stock and bond markets performed exceptionally well last year, and that helped boost the performance of Christine Benz's model retirement saver and bucket portfolios. She's here with me today to provide a recap. Christine, thanks for joining me today.
Susan, it's great to be here.
Happy New Year.
Happy New Year.
Let's start out with talking a little bit about the portfolios in general and what they are and where investors can find them.
Right. So these are on the quick links part of the homepage on Morningstar.com. You can find a link through to all of the different variations of portfolios. So we've created these bucket portfolios, which are designed for people who are in retirement. We've also created a suite of saver portfolios for people who are still saving for retirement. And within each of those silos, we have created different sub-portfolios. So we've created mutual fund portfolios composed of some of our analysts' highest conviction mutual funds, and we've also created ETF portfolios. We've also created some fund family specific portfolios. So we often talk to investors who say, well, I do all my business with Fidelity, or I do all my business with Vanguard or T. Rowe Price or Schwab. So we've created portfolios that are specific to those firms as well. I've also created some tax efficient portfolios. So for people who are investing within the confines of a taxable account, the idea is that we're trying to minimize the drag of taxes on an ongoing basis. The rest of the portfolios are created without regards for tax efficiency, so they're meant for your tax sheltered accounts.
So there's something for everyone, almost, right? And then what are the goals for the portfolios overall?
The goal is to, I think, showcase what I think are sound asset allocation principles. I think a lot of times asset allocation, like how to structure a portfolio, is kind of shrouded in mystery, and a lot of providers sort of say, well, you need to buy that from us. Our idea was to showcase sane asset allocation principles for people at various life stages and with various risk tolerances. And another idea behind the model portfolios is to take some of our analysts' highest conviction ideas, so whether mutual funds or ETFs, and show how they could work together in a portfolio.
So now specifically to recent performance, 2019 specifically, I'm guessing it was a pretty good year for the portfolios.
It was a great year, yes.
You just recently recapped the portfolios.
Yeah.
What were some of your findings?
So no special genius on my part in terms of putting them together. Almost wherever you invested in 2019, you did okay. Certainly the equity-heavy portfolios performed best. So within the saver suite, the aggressive portfolios performed best. They gained about 24-25%. And then the conservative portfolios, as you would expect, because they have more bonds, the bucket portfolios have cash as well as bonds. They didn't perform as well, but even there, returns were in the range of 13 to 15%. So a pretty good year overall.
Yeah. Now, I bet that's quite different from what you saw in those portfolios in 2018, the year prior.
It absolutely was. In fact, I was looking back on my recap of 2018 performance, and the headline really was that cash was the best performer in the bucket portfolios. The saver portfolios don't hold cash, so their short-term bond holdings were the best performers. But it was really a complete reversal, and I think Oakmark International Small Cap, which is a holding in the retirement saver portfolios, is a great example of just how completely things flipped in 2019. So in 2018, it had a 24% loss. It was really the worst performer in any of the portfolios. In 2019, it gained about 31%. Wow. So it didn't quite atone for that bad 2018, and you know how the math works out. When you have losses, it's hard to dig yourself out. But nonetheless, I think it does illustrate just what a reversal we saw in 2019, where the more aggressive you were, really, the better off you were last year.
Now, you have portfolios that are, largely ETFs and others that are largely mutual funds. Did you observe any differences in the portfolio between those two types?
Well, I try to keep an eye on that. And one thing that I have thought about in assembling the portfolios is I really try to keep the risk profile analogous. So the retirement saver portfolio for moderate investors in terms of its asset allocation and overall complexion, between the mutual fund and the ETF portfolio, they should be pretty tightly aligned. And I was happy to see when I compared performance, I really saw performance pretty much in lockstep. However, the total stock market index is a bigger holding in the ETF portfolios than is the case in the mutual fund portfolios. that was a tremendously strong holding last year. So investors who are just looking to a very vanilla product for their equity holdings did really well last year. The mutual fund portfolios do own some total market exposure, but they also own some active funds. We had a few, I would say, not great years among some of our active funds. Prime Cap Odyssey Growth is one of the core equity holdings in the retirement saver portfolios. It had a strong year in absolute terms, but not a great year in relative terms. Oakmark Fund didn't perform as well as total market index. So those held performance back a little bit relative to the ETF-only portfolios.
Gotcha. Now, if investors are following these portfolios on their own, what are some things they should be thinking about right now, or even with their own portfolios?
Well, any investor using a bucket strategy, so someone who's already retired, should take a look at their 2019 gains, and in my view, consider pairing some of the portfolio holdings that have appreciated the most, stripping back on them a little bit, refilling the cash bucket if you've spent from it over the past year, potentially topping up bonds as well. I think it's a good time to size up your total portfolio's asset allocation, potentially take some of your winnings and move them to the conservative side of the ledger. For people who are in retirement savings mode, I think that they probably also want to take a look at their asset allocation, but take special attention to the intra-asset class exposures in a portfolio. Even though foreign stock funds had a terrific year in 2019, generally speaking, they underperformed U.S. equities, so I think that's a repositioning that investors might consider. Also, looking at how your portfolio is arrayed across the Morningstar style box, value stocks generally didn't perform especially well in 2019, certainly not relative to growth, so you might be able to do some repositioning there as well.
That makes a lot of sense. Christine, thank you for your time today, and I'll see you a year from now to talk about the 2020 portfolio.
Sounds
performance
good.
of the portfolios.
Thank you, Susan.
Thank you. I'm Susan Jabinski from Morningstar. Thanks again for tuning in.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Alex Bryan with which parts of the market are more ideal for an active approach.
Hi, I'm Christine Benz from Morningstar.com. In what parts of the market are you better off sticking with passive products, and where is it reasonable to use active funds? Joining me to discuss that topic is Alex Bryan. He's Morningstar's Director of Passive Strategies Research for North America. Alex, thank you so much for being here.
Thank you for having me.
Alex, you recently delved into this topic in ETF Investor, and your headline takeaway is that it's perfectly fine to go all passive with your portfolio, but you did call out some parts of the market where it's reasonable to use active funds. And so one of the key areas you talked about was if you're looking at a market segment where the benchmark is not representative of what active investors are doing. And you called out the Bloomberg Barclays Aggregate Index as an index that isn't necessarily representative of what core intermediate term bond fund managers are doing. So let's delve into that.
Sure. So if you take a look at the composition of the Bloomberg Barclays Aggregate Bond Index, it tends to be quite a bit more conservative as far as its credit risk goes than most active intermediate core bond managers. So about 2/3 of that portfolio is parked in U.S. Treasuries and agency mortgage-backed securities. So it doesn't take a genius to figure out that if you take more credit risk than that benchmark, you can probably beat it. And that's in fact what a lot of active managers do. Now, if you consider the counterfactual, let's say that if you imagine that the aggregate bond index looked a lot more similar to how active managers in the category invested, it would be harder to beat, because if an index is representative of its active peer group, the gross of fee performance between the two should be similar, and the main driver of the difference would be the difference in fees. So the more similar an index is to its active peers, the more important fees become, and the more confidence that you have that low fees will translate into strong category relative performance. But where there are some differences, as is the case with the aggregate bond index, differences in fees may not be enough to get you better category relative performance.
Okay, so it's not as if you're saying this is an area where definitely use an active fund. In fact, we're seeing a lot of investors buying total bond market index products, and you think that's a perfectly okay way to play it, but this is also an area where it's not unreasonable to use an active fund.
That's right. So the payoff to credit risk isn't a free lunch, right? It is a real risk. Active managers who take greater credit risk have greater potential losses, if the economy turns south. So that's a real risk. The other thing that I think a lot of people overlook is that the payoff to credit risk is positively correlated with stocks. So if you are investing with an active manager who's taking a lot of credit risk, they may not be able to diversify your stock holdings as well as a more conservative bond index fund that favors treasuries and agency mortgage-backed securities. So there's nothing wrong with sticking to a broad conservative index fund in this group. It's just that they may not lead the pack as far as returns go.
Okay. Sort of the classic rationale for using an active fund is that there might be certain market segments where pricing inefficiencies can crop up, and those might be the places to go active. First, do you think that's a legitimate reason to go active? And second, if you do, what would be the areas that would qualify as susceptible to those pricing inefficiencies and therefore a decent place to use an active product?
Yeah, that's a great question. So mispricing is, I think, necessary for active managers to add value. And you would expect that active managers should do better in areas of the market where there's greater supply of mispricing. So I think the intuition there is legitimate, but it's not sufficient to lead to outperformance, because if mispricing helps some managers, it also will likely hurt other managers, because in aggregate, active management is a zero-sum game. So it certainly opens up some opportunities, but it's not sufficient to lead to outperformance. Now, as far as the areas of the market that likely are more susceptible to mispricing, I think that high-yield bonds, emerging market stocks, as well as small-cap stocks are key areas where mispricing might be more common than it would be in, let's say, large-cap U.S. stocks.
Okay. Can we delve into some of those and talk about why pricing inefficiencies crop up? Maybe start with high yield and talk us through why we do tend to see some of those mispricings and why maybe active managers can work okay.
Yeah, so one of the key issues here is a lot of these securities in the high yield bond market, as well as small cap stocks, they tend to be a little bit less heavily traded. So there are fewer investors following these securities. That means there's less competition to price these securities. So with fewer managers keeping track of what's going on with the fundamentals of the issuers of those bonds or the stocks in which they're investing, there's a greater chance that the prices of those securities may not fully reflect all the information that's available to the public. So that can open up some areas where some securities might be mispriced. Competition is really what's necessary to bring prices close to fundamental value. You need competition among a lot of well-informed investors, and areas of the market where there are fewer investors competing are good candidates where mispricing might crop up here and there.
What would be some other sources of mispricing?
Yeah, so there are some other frictions in the market that can lead to mispricing. So, for example, a lot of investment-grade bond managers are not allowed to hold anything that's rated below investment grade. So when you have an investment-grade bond that's downgraded below investment grade, that creates a lot of forced selling pressure. And that can cause these types of bonds, so-called fallen angels, to become undervalued. In emerging markets, you have other constraints like limits on foreign ownership and limits on shorting stocks in certain markets that can also act as a hindrance that prevents efficient price discovery. So there's a combination of different things, but I think just to summarize, small cap stocks, emerging market stocks, and high yield bonds are areas where these frictions crop up a bit more than other areas in the market.
Okay, so maybe more opportunities for active managers in some of those areas, but it's still important to keep an eye on costs, right? No matter whether you're going with a passive product or an active product.
That's right. In order to get back to even, active managers have to recoup their fees. The lower the fee hurdle that they have, the easier the task. So fees are always important.
Okay, so small cap, EM, high yield, those would be some areas to potentially consider using an active product. Let's talk about some areas where investors should definitely go passive, that the data and everything else we know suggest the advantages accruing to very low cost passive products.
I would be very careful with saying definite because very few things in investing are. There are good active managers really in all categories, but I think the odds of outperforming in large cap stocks are not quite as good as they are in some of those other areas of the market that we talked about. So large cap stocks are a really good candidate for index funds because these tend to be areas of the market where the indexes are representative of how active managers invest. Index funds charge a lot less than their active counterparts, so that works to their advantage. These are also areas of the market that are highly competitive, where there are a lot of well-informed investors who are competing against one another, driving prices toward their fundamental value. So it's very difficult for active managers to consistently outperform by identifying mispriced securities. So I think all those things really work in favor of index funds in these highly liquid, highly competitive large cap stock markets, both in the U.S. as well as in foreign developed markets as well.
Okay, Alex, it's always great to get your perspective. Thank you so much for being here.
Thank you for having me.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Now, Dan Romanoff highlights why wide-moat Aspen is well positioned for an oil and gas rebound.
We see wide-moat Aspen technology as an interesting niche software company selling into the industrial process automation vertical market. Aspen software optimizes asset design, operations, and maintenance in complex industrial environments. The Aspen One software platform helps improve process-oriented plant efficiency and thereby lowers capital intensity, increases working capital efficiency, and improves margins. This is high-end software that competes against offerings from industrial automation companies like Siemens, Emerson, and Schneider Electric. Shares have gapped up in the months since our mid-December launch. Most of that has occurred since tensions increased with Iran. Given that Aspen software is used predominantly for the oil, gas, chemical, and energy industries, at times, shares become decoupled from the underlying business fundamentals and trade based on the volatility of oil. We now see shares as overvalued. Outside of valuation, we see Aspen as a well-positioned company. Oil and gas CapEx has been restrained for more than a year and is set for at least a modest rebound in 2020, which we think will benefit Aspen. We also like the diversification effort in recent years away from core industries. Today, we see 7% of revenue coming from pharmaceuticals, consumer packaged goods, mining, paper and pulp, and so forth. We think this continues to pick up gradually over time. Given the mature industries Aspen serves, we view growth as being less robust than many of the software companies within our coverage, which we think it makes up for by generating among the highest non-GAAP operating margins in the market. Aspen already serves virtually all of the largest oil refineries, chemical companies, and engineering and construction companies. We see a $5 billion TAM for the company and see opportunity to add smaller clients as it continues to further penetrate its existing base of large customers.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patek as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, Emory Zink recommends how to pick a short-term bond fund.
Investors in short-term bond funds are typically seeking safety and have a low tolerance for losses. Shrewd offerings deliver on this goal by focusing on liquidity, diversification, and thorough risk management. Interest rate calls are difficult to get right, so you want to invest with a manager that has a disciplined approach to limiting the fund's interest rate sensitivity. Managers that are taking more liquidity or credit risk could expose investors to volatility, which may lead to outflows that exacerbate liquidity troubles, as we saw during the financial crisis. A few of our recommendations in the short-term bond Morningstar category, which take these concerns into consideration, include Baird short-term bond, which earns a gold rating on its cheapest share classes. This strategy is guided by an experienced team that stays within its guardrails. The fund is run duration neutral to its Bloomberg Barclays 1 to 3 year index benchmark, but the team has historically added value through thoughtful portfolio construction. Holdings are diversified across numerous names and sectors. In 2019, half of the fund's portfolio was parked in corporate credit, a third in U.S. Treasuries, and the remainder in asset-backed securities, mortgage-backed securities, and cash. The team doesn't shy away from BBB-rated fare either, but has exhibited good judgment with these selections historically. Another option is Fidelity Limited Term Bond, which earns a silver rating on its cheapest share classes. The strategy is benchmarked to the Bloomberg Barclays Government Credit 1 to 5 year index. The team manages duration closely to this benchmark, and subsequently this offering tends to court modestly more interest rate risk than its typical peer. The portfolio invests across a bevy of government, corporate, and securitized bonds, and it will hold up to 5% and below investment grade fare. But the research and risk management applied to these selections is both thorough and thoughtful. And for an investor wanting something without the heavy corporate credit bias, there's JP Morgan Limited Duration Bond, which earns a silver rating on its cheapest share class. This strategy is benchmarked to the Bloomberg Barclays 1 to 3 year index. But unlike this bogey, it explicitly focuses on securitized holdings, such as agency mortgage-backed securities, collateralized mortgage obligations, and asset-backed securities. This portfolio is a relative outlier in the category given its limited exposure to corporate debt. But the team supporting this fund has exhibited skill in selecting securitized structures in the past. And this gives it an advantage during periods of credit stress relative to peers holding larger allocations to corporate credit.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.